The stock market has long been seen as the gateway to wealth, yet for many it remains intimidating, confusing, or even risky. Headlines about sudden crashes, skyrocketing stocks, or overnight millionaires often overshadow the fact that successful investing and trading is a skill, not luck. Whether you're just starting out or looking to refine your strategy, understanding the core principles of the market is essential for building long-term financial success. Investing isn't about gambling or following trends blindly. It's about making informed decisions, managing risk, and creating a plan that aligns with your goals. From learning the basics of stocks and market indices to mastering fundamental and technical analysis, every step builds the foundation for smarter, more profitable decisions. Trading, too, has its place, offering opportunities for short-term gains if approached with discipline and strategy. But without proper knowledge, risk management, and a well-defined personal plan, even experienced investors can face costly mistakes. In this video, we break down stock market investing and trading into 7 essential points, giving you the tools, strategies, and mindset to navigate the market with confidence, minimize risk, and grow your wealth systematically over time. Let's watch. 1. Understanding the basics: stocks, indices, and markets. Before diving into investing or trading, it's crucial to understand what you're dealing with. Stocks represent ownership in a company, and their value fluctuates based on company performance, market sentiment, and economic factors. Investing in stocks means buying shares in companies you believe will grow in value over time. Beyond individual stocks, market indices like the S&P 500, Dow Jones Industrial Average, and NASDAQ provide a snapshot of overall market performance. These indices are often tracked by investors through index funds or ETFs, which allow you to invest in broad market trends rather than single companies. The stock market also operates on exchanges such as the NYSE or NASDAQ, each with its own listing rules and types of securities. Understanding market mechanics, including trading hours, order types, and liquidity, is the foundation for effective investing and trading strategies. Without grasping these basics, making informed decisions becomes far more difficult, increasing the risk of losses. 2. Long-term investing: the power of buy and hold. Long-term investing is about buying stocks with the intention of holding them for years or even decades. This strategy relies on the concept of compound growth, where reinvested dividends and capital gains accumulate over time. Successful long-term investors focus on companies with strong fundamentals, including consistent earnings, a competitive advantage, strong management, and potential for growth. Warren Buffett's approach is a classic example. He invests in companies he understands, trusts, and believes will generate sustainable profits over decades. A key tool for long-term investing is the diversified portfolio. By spreading investments across sectors, industries, and asset classes, you reduce the risk of being overly exposed to any single company or market fluctuation. Index funds and ETFs are excellent vehicles for long-term strategies because they provide broad market exposure with low costs. Patience is critical in long-term investing. Short-term volatility is inevitable, but historically, markets trend upward over extended periods. Investors who stick to a disciplined strategy often achieve significant growth, even during periods of economic turbulence. 3. Fundamental analysis: evaluating company value. Fundamental analysis is the process of evaluating a company's financial health and growth potential to determine whether its stock is overvalued or undervalued. This method focuses on financial statements, earnings reports, debt levels, profit margins, and competitive positioning. Investors using fundamental analysis often look at metrics like price-to-earnings P/E ratio, price-to-book P/B ratio, return on equity ROE, and free cash flow. These indicators provide insights into whether a stock is reasonably priced and has growth potential. For example, a company with strong earnings, manageable debt, and consistent revenue growth may be undervalued if its stock price doesn't reflect these fundamentals. Conversely, a hyped stock with weak financials may carry high risk despite short-term popularity. Fundamental analysis suits long-term investors aiming to buy quality businesses at a fair price and hold them as they grow. It helps reduce emotional decision-making and provides a rational basis for investment choices. 4. Technical analysis. Timing the market. While fundamental analysis focuses on the underlying value of a company, technical analysis examines historical stock price movements, volume, and patterns to predict future price behavior. Traders use charts, indicators, and trend lines to identify buy and sell signals. Common technical tools include moving averages, RSI, Relative Strength Index, MACD, Moving Average Convergence Divergence, and support resistance levels. These indicators help traders spot trends, reversals, and potential entry or exit points. Technical analysis is widely used in short-term trading, including day trading, swing trading, and momentum strategies. While it requires skill and experience, it provides a systematic approach to timing trades, managing risk, and maximizing returns. It's important to note that technical analysis is not foolproof. Market psychology, news events, and unexpected economic factors can disrupt trends, making risk management essential. Combining technical and fundamental analysis often provides a more balanced approach to investing. 5. Risk management. Protecting your capital. No investment strategy is complete without a robust approach to risk management. Successful investors and traders prioritize capital preservation, understanding that losing money can derail long-term goals. Investors should also assess personal risk tolerance. Younger investors may tolerate more volatility due to a longer time horizon, while retirees often prioritize stability and income over growth. Understanding your risk profile ensures that your investment strategy aligns with your financial goals and emotional comfort. Finally, never invest money you cannot afford to lose. A disciplined risk management approach allows you to stay in the market through volatility, increasing your chances of long-term success. 6. Trading strategies. From day trading to swing trading. Trading strategies vary widely based on time horizon, risk tolerance, and market expertise. Day trading involves buying and selling stocks within the same day, aiming to profit from small price fluctuations. This strategy requires constant monitoring, quick decision-making, and significant market knowledge. Swing trading, on the other hand, seeks to capture short to medium-term trends, holding positions from a few days to several weeks. Swing traders use a combination of technical analysis and market trends to identify opportunities while avoiding the extreme intensity of day trading. Momentum trading focuses on stocks with strong recent performance, while contrarian strategies target underperforming stocks expected to rebound. Regardless of the approach, successful trading relies on discipline, strategy, and consistent evaluation. Emotional decisions, such as chasing losses or reacting to market hype, are the fastest way to incur losses. 7. Building a personal stock market strategy. The final step in stock market investing and trading is creating a personal strategy tailored to your goals, risk tolerance, and time horizon. Long-term investors might prioritize fundamental analysis, dividend growth, and diversification, while traders may focus on technical patterns, short-term momentum, and strict risk controls. Consistency and discipline, rather than trying to time the market perfectly, are the hallmarks of successful investors and traders. By combining knowledge, risk management, and a structured approach, you can navigate the stock market confidently, grow wealth over time, and seize opportunities without being derailed by fear or speculation. Conclusion. Mastering stock market strategies. Stock market investing and trading offer immense potential for wealth creation, but success is rarely accidental. Understanding the basics, committing to long-term growth, performing fundamental and technical analysis, managing risk, and tailoring a personal strategy are all critical components of success. Investing isn't about gambling, it's about discipline, education, and strategy. Whether you're a beginner seeking long-term growth or an experienced trader aiming for short-term gains, applying these 7 points gives you a structured roadmap. Let us know in the comments what you think about the stock market investing and trading strategies, and don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.